Good day, everyone. Welcome back to Profit Arena. In today's video, I'm going to be explaining how to read the chart like a pro, explaining the fundamentals of price, the elements of price, and the reference point for each of the elements of price. Please pay rapt attention because price is the bedrock of technical analysis. Remember, this channel was created with you in mind. I'm going to hold your hand all through this journey to ensure you become a profitable trader, and you'll be getting all of this mentorship, all of this information for free. All right. Now, without further ado, let's dive into it. So what is price? Price is the amount a commodity is bought or sold for, right? Price refers to the amount a seller is willing to sell a product. And price is also the amount a buyer pays for a product, right? Now, so for sales to happen, there has to be an agreement between the buyer and the seller. And that agreement has to do with price, right? That's why price is very, very important, not just in our local markets, right? But also in the financial market, be it the stock market, be it the cryptocurrency market, the FX market, that's the forex market, right? You still have to agree on price before you open a position. So it is safe to say that price is the determinant for buy and sells. It is safe to say that price is the determinant for buy and sell positions in the financial market. Now, this, for example, is a chart of Euro CHF. If I'm going to enter this trade, if I'm going to take a trade, whatever price, I have to agree with the price here, right? I have to agree with the current price of this product before I'll take a position here. I'll have to agree with the current price. Now, this here is the current price. This is the current price of this product. So if I want to buy this product right now, I am buying this product at this price. And also, if I want to sell this product, I am selling this product at this price as well. So long as you have your money, you can do whatever you want to do. You can either buy or sell at an agreed price. All right? So like I said earlier, price is the bedrock of technical analysis. Everything we are going to be discussing on technical analysis is built on price. That's why as a trader, you need to understand the concept of price. If you don't understand price, you're going to have problems, right? Even in our local market, if you don't know the price of a commodity or if you don't know the price of product, you might actually buy that product on the high side. You might pay, more than the actual worth of that product, right? Now, one thing that makes trading or technical analysis really easy is the fact that price can do one thing per time. Price can do just one thing at a time, right? Now, there are four things that price can do, four elements of price, but amongst these four elements of price does one of them per time. So what are these elements? Number one is called consolidation. Number two is called expansion. Number three is called retracement. Number four is reversal. All right. Now we are going to look at each of these elements in detail, and we're also going to look at the reference points for each of these elements. Right? Now let's look at the number one quickly, which is consolidation. Right? Now consolidation is when price moves from a point to another point without an impulsive move. This is what I mean. When price moves from a point this way to this point without breaking out of this range, we say price is consolidating, right? And consolidating can be single, right? It can be double, and it can be multiple, right? It can be single, double, and multiple, right? This is consolidating. This is a consolidating market. This is a consolidating market. Because price is trapped within this zone. Price is trapped within this zone, right? Within this zone. It's not breaking out to the upside, neither to the downside. So when this happens, we say price is consolidating. Price is ranging. Another name for consolidation is called a ranging market. Now let's quickly look at a consolidating market, right? Let's quickly look at an example in our chart. All right, now this is a consolidating market. Why is it a consolidating market? It is a consolidating market because price is within this range, is moving within. At an example of a consolidating market, all right, and a real life chart. So this is a real life market, right? Remember we say consolidation is when price moves within a range, right? Within a range. So this is a consolidating market. So this is multiple consolidation. Remember, we also say that consolidation could be single, multiple, or double, right? Look at another. This is a double consolidation, right? Double consolidation. So that's that. You can, practice. This is another double consolidation. This is another consolidating market, right? This is another consolidating market. So that's that for consolidation, right? Next we'll be talking about is expansion. Now, expansion precedes consolidation. Expansion precedes consolidation. Now, what is an expansion? Expansion is when price moves impulsively. Right? Remember we say when the market consolidates, it moves this way, right? Now, expansion happens when this market breaks out of this consolidation zone. So we say, well, this is an expanding market or an expanded market, right? This zone has been broken. This consolidating zone has been broken, right? So we say this market has expanded. All right, so let's quickly look at real life chart of an expanded market. So this is a consolidation market, and this is a perfect example, right? A consolidation market preceded by what? By an expanding market. Let's look at what happened. Look at this. Look at what happened here. Price gave us double consolidation and then broke out with this momentum to the upside because it just kept going up and up and up and up, right? So this is a perfect example of a consolidation of an expansion preceded by a consolidating market. Now, please, let me note this. Don't always think there needs to be a consolidation before an expansion happens. No, that's not always the case, right? The expansion can happen without consolidation. Let's say in a scenario like this, right? Price can do something like this, just creating, all these layers to the top side, right? Price can do something like this. This is an expansion. This is an expanding market. From this zone to this zone is an expansion. From here to here is an expansion. Is another expansion, right? So all of these is an expanding market, but there is no consolidation here, right? There is no consolidation here. So it is possible for price to expand without consolidating, right? Just that market consolidates to build momentum, to either continue in that direction or to change direction. Whichever way, it needs momentum to move, all right? So that's that about an expanding market. So let's look at real life chart, more examples of an expanding market. Now, this is expansion. This is a beautiful example of an expanding market. Look at this, right? Look at what price is doing, moving impulsively to the downside, right? You just keep moving impulsively to the downside. So this is an expansion, right? This is an expansion. Remember, we had an expansion to the upside and now another expansion, right, to the downside within this structure, right? Within this structure, we had example. Now, if you go to the higher time frame, there is a different story to all of these, but for now, we accept these as well as expansion to the downside, expansion to the upside for your level. But as we go deeper into this course, you're going to have a different narrative to what I just told you guys. All right. So that's that for expansion. So the next thing we'll be looking at is retracement. Retracement. Now, what is a retracement? Retracement is when price pulls back into the consolidating zone or into the consolidation zone, all right, without taking out the zone. When price pulls back into a consolidation zone without taking out the zone, right? This is what I'm talking about. Now, look what happened here. We expanded from this zone, right? We expanded from this zone. After the consolidation, we expanded from this zone, right? Then look at what price did. Price did not just continue moving up infinitely, right? Price retraced. Price pulled back. Now, this pullback into this zone, look at this zone. This is a consolidating zone, right? This pullback into this zone here is what we refer, before price continues the movement to the upside, is what we refer to as what? To as retracement. This pullback to this zone after price expanded is what we refer to as what? To as retracement, right? So this is another retracement. So this is another retracement as well. This pullback, right, before another expansion. The pullback before another expansion is what we refer to as what? To as a consolidation. Sorry, retracement. Now look at this scenario as well, right? Price expanded down here, right? Price expanded down. It retraced this pullback here into this zone, into about 50% of this zone where price expanded from, is retracement, right? Then price expanded again, and then it retraced again, it pulls back again, and then it keeps expanding. Now, let me explain quickly the psychology behind expansion, behind retracement. Now, when price is moving in a certain direction, let's say price is buying, right? Let's say price is just buying, moving to the upwards. Remember, for a market to be healthy, right? For a financial market to be healthy, or any market at all, there needs to be a balance between the buyers and the sellers, right? There needs to, even if the market is buying, there needs to be a presence of the seller, right? If you are looking at a chart and there is no seller, it's just a buying market, run away from such market. Also, when you see a market that is just selling with no buys, run away from that market, right? Because there is no seller. It means that this element of price, which is called retracement, is abolished. It means that such price is inefficient. Such price is not healthy, right? For price to be healthy, these four elements must come into play. So when price retraces, even if price is buying, when price retraces, it's more like paying respect to the opposite party, right? More like, like recognizing the presence of the opposite party. More like, okay, this is a seller saying, oh, we are still here. We are still trying to fight to take control over price. We are still trying to, push price down, right? Even if the buyer overpowers them, at least there is a record that they fought, right? There is a record that they fought. So this is what this retracement is all about, all right? And also, when price retraces to get enough liquidity for the movement downwards, right? Price retraces to get enough liquidity to continue that movement, right? Because whether you like it or not, for example, okay, we'll talk about that as we proceed with the mentorship program. Let me not make it ambiguous for you guys. So retracement is this pullback that happens whenever price expands. These pullbacks that happens, right? Let's look at more examples. Okay, look at this is what I'm talking about. Price expanded down here, and then it had to retrace up to this zone, right? Before another leg down, right? So this is what we refer to as retracement. So we are going to look at the next one. The next one is called reversal. The next one is called reversal. Now, from the name reverse, I believe you already know what that means literally, right? When there is a change in direction, right? That's what reversal means, when price changes direction. So let's say a buying price decides to change direction. Look at this market, for example. Look at this market. This market was buying all the way here, all the way here. This is a buying market, right? Up until this point, right? Price was expected to go and create another high, right? To continue the movement, but instead it failed, right? It failed and then decided to move downwards instead. So when this happens, when price change direction, we say price has reversed. Price has reversed. Now, how do we tell, or what are the parameters, or what are the things to look out for when reversal happens? Reversal happens when this retracement, this retracement that created a new high is being taken out. Remember, price from this point to this upside, price fulfilled, or this zone fulfilled its obligation by creating a new high, right? Now, instead of price to continue moving in that direction, instead price decided to snitch on this person, right? Price decided to, snitch on this person or try to backstab this person and instead took the person out, right? So when this happens, we say this is a negative occurrence, and because it's a negative occurrence, reversal has taken place. So it means price has discontinued from moving upwards and now wants to move downwards, right? So in this situation, we say this is a reversal. This is a reversal. So reversal is the change in direction. Change in direction. Now, the change in direction can be a change from a buying market to a sell market, or a change from a sell market to a buying market, right? Whichever it is referred to as reversal. All right, so let's quickly look at the elements of price. Let's quickly look at the reference points for the elements of price. The reference point for the elements of price. The first one we look at was consolidation, right? We say consolidation, and then we use this example. Now, the reference point for a consolidating market is called equilibrium. Now, there are some persons that they are traders that trade consolidating markets. There are traders that trade consolidating market, right? Now, how do you trade a consolidating market? If you want to trade a consolidating market, you're going to have to mark out your zone, right? When you mark out your zone, then you are going to, divide that consolidation zone by 50, right? 50%. You're going to accurately divide it by 50%. Now, when you divide it by 50%, it means that when price goes up, it means within this range, when price goes up here, you're going to sell. You're going to be selling from the top here. You're going to sell down, right? And also, when price gets here, you can also buy from here to this zone. It means you sell down and then you buy up within this range. So long as price remain within this range, you just keep buying. You buy from this zone and then you buy from this zone here upwards, and then you sell downwards, right? So long as the consolidation remains. This is what happened here. This is what happened here, right? Look at this our consolidation zone, right? So let's say this is the 50%. Let's say this is the 50%. It means that whenever price gets below this 50% line, I'm going to be buying, right? So it means I'll be buying from here, right? I'll be buying from this zone to the top side, and also I'll be buying from this below this 50% line, and I'll also be selling from above this 50% line as well. I'll be selling above and I'll be buying below, right? I'll be selling above and I'll be buying below. So when price cross this line, I'll look for sales. I'll just start selling, right? When I see my confirmation, right? And also when it gets below this 50% line, I'll look to buy this market, so long as the consolidation remains. But I don't advise trading consolidating market because it's very, very risky. It's not worth it. So, but just for the knowledge, right? I'm just teaching you guys so you can have a proper knowledge of what a consolidating market is, so that when you come across a consolidating market, you just stay out of the market. You don't trade it because it is highly unpredictable. All right. So that's the reference point for what? For consolidation, the equilibrium. Now let's quickly look at the reference point for expansion. What is the reference point for expansion? Now, whenever a price expands, it leaves behind a value area. It leaves behind a value area. Whenever price expands, it leaves behind a value area. Now, this value area is where price always comes back to retest, right? Price will always come back to retest most of the time, not every time, but most of the time, price will come back to retest this zone before it continues moving in the intended direction. Now, remember when we're talking about consolidation, we say this was consolidation that was preceded, right, by an expansion. So this was where the expansion happened from to the top here, right? Now, so this the reference point for expansion is called an order block. Order block is the reference point for expansion, right? So, and what is an order block? An order block, we have two types of order block, right? We have the bullish order block and we have the bearish order block. Now, let me just put it in simple terms. We have the buying order block and we have the selling order block. Now, the buying order block is the opposite candle, right? It's the opposite to the buy candle. The last opposite to the buy candle before price expanded. The last opposite buy candle, the last opposite candle to the buy candle before price expanded. So in this scenario, this was where the expansion happened from, right? This zone right here. This was where the expansion happened from, right? So this candle here, this black candle is the last opposite candle before price expanded. Is the last opposite candle, right? Before price expanded. Now look at what price did. Price eventually came back to it. Right after moving, this long distance to the upside, price eventually came back and retested this zone and then zoom off, right? So when this happens, we say this is a retest, right? So this is price retesting what? An expansion. So this is what is the reference point. The other block is now the reference point for expansion. All right. Let's look at more chart examples, right? Let's look at more chart examples. This is another example as well. Price expanded from this zone. Price expanded from this zone, and then this is the last opposite candle. Look what price did. Price came back to it, right? Price came back to it. So price always comes back to, and also look what happened here. Price broke down here to the downside. Look at what price did. Price came back to this opposite of the sell candle, right? Price came to retest this last candle here. This opposite to the sell candle. Price came back to it. Price came back to it and price sold, right? So that's that for expansion. So the next reference point is retracement, right? Retracement, the reference point for retracement is called imbalance. You can call it imbalance, you can call it fair value gap, imbalance, fair value gap, or liquidity void, right? You can call it imbalance, fair value gap, or liquidity void. Each of these names can be used, right? So what is an imbalance? An imbalance is referred to as the space in between candles, right? Space in between candles. Now, remember when I was explaining to us about retracement, I told us that for a market to be healthy, there needs to be the presence of the opposing party, right? There needs to be the buyer and the seller, and there needs to be a balance between the buyer and the seller, right? Now, so when there is a gap between candles, we refer to such situation as an imbalance, right? It means price needs to come back to fill that zone for the market to be balanced, or for price to be balanced. Now, in this CD, this is how the candle should be. In an ideal market, this is how a candle should be like. This is how candles are meant to overlap each other, right? Candles are meant to overlap each other. either with the body of the candle or with the wick, right? Either with the body of the candle or with the wick. So you see in this scenario, this previous candle has been overlapped, right? Sorry, this is supposed to be here. This is supposed to be here, right? This is a buying candle. This is a buying market, right? This is a buying market, supposed to be here. So you can see that this middle candle here has been overlapped, right, by the body and the wick of this candle. This is how candles are supposed to be. But in a situation where you have a candle this way, you have another candle this way, and then you have another candle this way, right? Let's say in this situation where you have candles like this, right? And let's say you have candles this way. This is just a rough sketch, so pardon my. So let's say you have something like this, right? You have something like this. It's a situation where, you know, the candles, now there is space here. There is space in between this candle that was not overlapped, right? There is space here between these candles here. So when this happens, we say this is an unhealthy market. This is an unhealthy market. So what will price do? Price will often come back to fill it before continue going up, right? So let's look at chart examples of retracement of imbalance, right? Let's look at chart examples. Look at what happened here. Look at this scenario here. Look at price all the way to this zone. There was no overlapping of candles, right? Look at this. Look at this first candle. Let me take this out. Look at this first candle here. There was no overlapping by the preceding candle, right? Look at this as well. Look at this as well. Space here. Now look at what price did. Price had to come back. Price had to come back all the way. Came back all the way, you know, to fill up this space before moving up, right? So when this happens, we say the imbalance is what is the reference point for retracement. It means that when price, what the reference point really means is when price get to these elements of price is expected to continue that movement, right? Price is supposed to correct this abnormally and then what continue moving on, right? So that is what an imbalance is. You also look at this scenario here. Look at this space between these candles here. You see what price did. Price came back. That's what price is doing right now, filling this imbalance. That's what price is doing right now, right? So yeah, this is what an imbalance means, and we say imbalance is what is the reference point for retracement. So it means that when you have a market going up this way, when you have a market going up this way, right? And so there is every possibility that price is going to continue moving after filling up an imbalance that was left here, right? And also after filling up an imbalance that was left here. Most of the time, this is what price will do, right? Most of the time, especially when the trend is an aggressive trend. All right. In our next video, we are going to be talking about market structure in full, so you're going to understand what trend means and all of these terminologies, right? I've actually not used these terminologies just so I don't confuse us, but in our next videos, I'm going to be introducing us to those terminologies and how you can use them as a trader, right? So the last one is what is reversal. The last one is reversal. And the reference point for reversal is called liquidity pool. Liquidity pool. Now, most of the time when price wants to reverse, it will start consolidating, right? It will start consolidating to build momentum, to trap both the buyers and the sellers. Remember, when the market is consolidating, since it's not moving to the upside, neither to the downside, the buyers will be involved and sellers will be involved. Each of them will be hoping that the market will go their way, right? And when the market does this, it's simply building a momentum or liquidity for the next move, right? So when the market, so let's say for example, a market that was buying and wants to start selling, right? It will do something like this, Then let me start all over again. Let's say the market was in a bull, it was in an upward movement. Let me just use that word, an upward movement. It will get to a point where you to start, consolidating this way, right? Building momentum, and then all of a sudden it will just move downwards, boom, right? So in this situation, we say this zone here, all of this zone here is what? Liquidity pool. Also, this zone here is liquidity pool. The price used to what? To carry out this reversal movement. Remember, reversal is anti-trend, anti-movement of the initial direction, right? So this is a coup. Let me use that word. This is a coup that happened, right? This consolidation here was a coup to change the direction of price. Let's quickly look at chart examples, right? Chart example, a clear chart example. Now look at this scenario. Look at this scenario quickly. Look here. Price was buying, and all of a sudden it just started retracing. It just started, consolidating here, and then look at what happened. Boom, broke to the downside. Boom, right? You just continue selling. So there was a mini consolidation within this zone. Right? There was a mini consolidation within this zone that aided the change in the direction of price. Also, look at this zone as well. There was a although this was a continuation of the trend, this was a movement to the downside, but still there was a mini consolidation, right? And then boom. So whenever price wants to retrace, it will arrange liquidity pool. So all of these things you're seeing here is what is for liquidity. This is called liquidity pool, right? Liquidity pool, and also all of these things you saw here as well. They are all liquidity pool. Look at how price took them out before it started selling down, right? So that's that for reversal. If you have any question, please ask in the comment section. I'm more than willing to attend to all your questions. All right. Now, so I'm going to leave you guys with a quiz, right? So I need you to answer this quiz and drop your answers in the comment section. I'm going to be looking at them, and I'm going to be reacting. If you're wrong or if you're right, I'm going to be reacting to your comments. All right. So thanks for watching this video. I hope you're taking notes. Please subscribe, like, turn on the notification so you can always be notified when there is a new video, and please share with your friends so you can help other persons as well to learn this skill that will possibly change their life. All right. So thanks once again. See you in the next video. Peace.